I lost $750 without spending a single cent. I didn't make a bad trade. I didn't pick the wrong stock. I just waited. And that is what thousands of Canadians are doing right now.
The market is at an all-time high. If you are sitting on cash waiting for a crash before you jump in, you are actually paying a waiting tax.
I used to do this. I told myself, it looks too expensive. I will wait for a dip. The dip never came. The market kept climbing, and I stayed on the sidelines.
Today, we are breaking down the math of what waiting actually costs you, why all-time highs are a good sign, and the simple Canadian strategy to automate your wealth.
I will also share the specific stock mistake I made and how I fixed it.
Quick reminder, this is our personal experience for educational purposes only, not financial advice. Always do your own research. Let's get into it. Imagine you have $15,000. You're nervous, so you wait. Month 1, the market goes up 3%. That is $450 you didn't earn. Month 2, it goes up another 2%. That's another $300 gone. Finally, the crash happens. The market drops 5%. You feel like a genius for waiting, right? Wrong. You are already down $750 in missed gains. The 5% drop only brings the price back to where it was when you first started waiting. You didn't save money. You just missed the growth.
So the dip has to be bigger than the gains I missed while I was waiting for it?
Correct. And the market doesn't follow your schedule. It could go up for 2 years before it drops 10%. By then, you've missed 30% in growth. Every month on the sidelines is a month of compounding you can never get back.
Compounding is the secret sauce. It is not just your money growing. It is your gains making their own gains.
People think an all-time high is a peak, like the top of a mountain where the only way is down. But the stock market is more like a staircase. In 2017, people said it was too high. In 2019, they said it again. If you looked at the S&P 500 over the last 30 years, almost every top was just a step on the way to a higher one.
But it feels so high right now. Shouldn't we expect a correction?
Corrections are normal. They happen. But even if you bought at the absolute worst time, right before the 2008 crash, and you simply held on, you would be incredibly wealthy today. Time in the market always beats timing the market. Waiting is even more dangerous if you are holding individual stocks.
That was my mistake. I held Amazon for nearly a year. I checked the price every single morning like it was my job. After 300 days of stress, I finally gave up and sold for a $4 loss. The very next day, the price jumped. If I had waited just 24 more hours, I would have been in the green. It felt like the market was watching me specifically just to mess with me.
That is the final sting of the individual stock trap. It makes you feel like you are playing a game against the market and losing. When you track one company, you are vulnerable to that kind of bad luck and emotional exhaustion. But with an ETF like XEQT, you aren't playing a game. You are the market. If one stock spikes or drops the day after you buy, it doesn't matter because you own 9,000 others. You trade that bad luck for market math.
Once I moved to ETFs, I stopped caring what happened the next day. I started looking at the next decade instead. The stress just disappeared.
So let's stop the gambling and start the building. Here is the specific setup for Canadians. Step 1. Open a TFSA. This is your tax-free gold mine. Every cent you earn inside this account belongs to you. The government cannot touch your gains.
If you are at least 18 and live here, you have contribution room waiting for you right now. You can see your total limit by logging into your CRA My account.
Step 2. If you want to buy a home, open an FHSA today. This is the one people miss. You do not get that $8,000 of annual room until the account is open. Even if you have $0 to deposit, open it now to start the clock on your contribution room. Step 3. Pick one ETF. XEQT covers Canada, the US, and the world. You don't need to be a researcher. You just need to own the market.
And since Wealthsimple allows fractional shares, you can start with as little as $50. You do not have to wait until you can afford a full unit. What if someone keeps cash on the side just for when the market drops 10 or 20%? Is that a good strategy?
It sounds smart, but nobody actually executes it. When the market drops 10%, the news is terrifying. People panic. You assume it will drop further, so you wait. Then it recovers fast, and you miss the bottom.
So the crash you wanted finally happens, and you are too scared to buy.
The investors who win during a crash are the ones who already had an automated plan. They were not waiting. They just kept buying. And here's the thing about automation. It actually makes crashes work for you. When the market drops and your automatic buy fires anyway, you are buying more units at a lower price. You did not have to be brave. The system did it for you.
So the crash you were afraid of actually becomes the best day of the month. So the real strategy is same amount, same day, every single payday?
Exactly. Automate it. If the market is up, you buy. If the market is down, you buy even more because the price is on sale. Here is your action plan for this week. Not next month, this week. 1. Open your TFSA. 2. Open an FHSA if you qualify. 3. Set up a recurring deposit from your checking account on payday. 4. Set up an automatic buy for XEQT. 5. Stop watching the market every day. Your only job is to let the system run.
When I finally stopped trying to be smart and just trusted the automation, that is when my wealth actually started to grow.
The market hitting an all-time high is not a warning sign. It is a sign of a healthy, growing economy. The only guaranteed way to lose money is to stay in cash while the world moves forward without you.
Automate it. Hold it. Let it grow.
If you want to know how hitting your first $100,000 changes the math of compounding, watch this video next. And if you are still not sure whether dividend ETFs are right for you, that answer is right here. See you there.